Hello, my name is Yana. Today I'm going to talk about dividends, capital gains, and losses. Learning objectives: dividends, qualified dividends, and non-qualified dividends. What are capital gains and losses? Types of capital gains and losses: 25% gains, 28% gains. First of all, let's define dividends on tax return. So, dividends are reported by shareholders on their personal tax return on Schedule D, capital gains and losses, and the total of all dividends received should be included in the income section of Form 1040. Dividends are taxed at a special dividends tax rate. In most cases, dividends are taxable as ordinary income to the recipient. In order to understand how dividends are taxed depends on how they have been held by the recipients. There are two types of dividends: ordinary or non-qualified dividends and qualified dividends. What is the difference between qualified and non-qualified dividends? The primary difference between these two lies in the way in which you pay taxes on them. The difference between non-qualified and qualified dividends is that qualified dividends are taxed at the applicable long-term capital gains rate, while non-qualified dividends are taxed at a person's regular income tax rate. Ordinary dividends and qualified dividends each have been different tax rates. Ordinary dividends are taxed as ordinary income. Qualified dividends are taxed at 20%, 15%, and 0% rate. In order to be taxed at the lower capital gains rates, first, the dividends must be paid by a USA corporation or a qualified foreign corporation. To be a qualified foreign corporation, the company must be either incorporated in the USA states eligible for tax benefits under a tax treaty between the United States and the foreign country, or the stock is easily traded through the established security market in America. How can I tell if a dividend should be qualified or not? A dividend being qualified or not is determined by a basic formula. If the shares are owned for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date, then the dividend is qualified. Otherwise, it's not. Example: assume John decided to buy dividend-paying stock to achieve financial objective. He invested $100,000 in Coca-Cola stock, which he intended to hold for 5 years. How much dividends will John report at the end of the first year if the dividend payment provided an 8% rate on return on his investment? Solution: $100,000 multiplied by 8% will be $8,000 of dividend income. What amount of tax will John owe if the dividends are qualified? Assume John's tax rate of qualified dividends is 15%. Solution: $8,000 multiplied by 15%, it will be $1,200. Now, I will represent you a definition of capital gains and losses. Capital gains and capital losses are the gains or losses that a company or an individual experiences on the sale of capital assets. If the selling price of an asset is higher than the owner's basis in that asset, the result is a capital gain. What is capital gain? A capital gain is what the tax law calls the profit you received when you sell a capital asset, which is property such as stock, bonds, mutual fund shares, real estate, etc. This doesn't include your primary residence. Special rules apply to those sales. Advantages of investing in capital assets from a tax perspective. First, gains are deferred for tax purposes until the taxpayer sells or otherwise disposes of the assets. Second, gains generally are taxed at the preferential rates relative to ordinary income. Tax deferment. One advantage of capital gains tax is that tax payments are deferred until the asset is sold. For example, a real estate advisor doesn't pay taxes on the equity gained in a property investment until the year he sells the property for a profit. Further, a securities investor doesn't pay capital gains taxes on profit earned from stocks and bonds until he takes a distribution or sells the assets. Investors only pay taxes during the tax year they realized the gain. This is different than income taxes, where you must pay a tax each time you receive an income payment. Profit reduction. According to the Internal Revenue Service, nearly everything you own for personal use or investment purposes is a capital asset. A drawback of owning capital assets is that if they are sold for profit, the IRS requires that you report gains as the income. The disadvantage of this tax is that it can reduce the overall profit realized from the sale of the asset. Exist several types of capital gains. The amount of taxes you must pay on capital gain depends on the length of time you own the asset prior to selling. It can either be a benefit or determined to the law payer. If you own the asset longer than 12 months and realize a profit, you have a long-term capital gain, which is taxed at a lower rate. If you own an asset less than 20 months and sell it for a profit, you have a short-term capital gain, which is taxed at a higher rate. Long-term capital gains tax are more advantageous than short-term capital gains taxes because their rate typically produces savings. The same applies to the dividends paid by an asset which earn capital gains but do represent a profit. Here we can see a table with the different rates for long-term capital gains. How capital gains taxes work. If you buy $5,000 worth of stock in May and sell it in December of the same year for $5,500, you have made short-term capital gains of $500. If you are in the 22% tax bracket, you have to pay the IRS $110 of your $500 capital gains. That leaves you with $390. Instead, if you hold on it until the following December and then sell it, at which point it has earned $700, it's a long-term capital gain. If your total income still puts you in the 22% bracket, then you will owe tax at just the 15% bracket for that capital gain. Instead of paying $110, you will pay $105 and see $595 worth of profit instead. What are the capital gains tax on property sales? Again, if you make a profit on the sale of any assets, it's considered a capital gain. With real estate, however, there are different rules for avoiding a capital gains tax hit. For profit on your main home to be considered a long-term capital gain, the IRS says you have to own the home and live in it for 2 of the 5 years leading up to the sale. You can exempt up to $250,000 in profits from capital gain taxes if you sold the house as an individual, or up to $500,000 in profits if you sold it as a married couple filing jointly. If you are just flipping a home for a profit, however, you could be subjected to a steep short-term capital gain tax if you buy and sell the house within a year or less. 25% capital gains rate for certain real estate. A 25% rate applies to the part of the gain from selling real estate and depreciated, typically when you have rented the house to someone. Basically, this rule keeps you from getting a double tax break. If the IRS first wants to recapture some of the tax bricks you have been getting via depreciation through the years in assets known as Section 1250 property, you will have to complete the worksheet in the instructions for Schedule G to figure out your gain and tax rate for these assets, or your tax software will do this figuring for you. 25% capital gains. Two categories of capital gains are subject to the 28% rate: small business stock and collectibles. If you realize a gain from qualified small business stock you held more than 5 years, you generally can exclude 1/2 of your gains from income. The remainder is taxed at a 28% rate. You can get the specifics on gains on qualified small business stocks in IRS publication 550. If your gains came from collectibles rather than a business sale, you will also pay the 28% rate. This includes proceeds from the sales of a work of art, antiques, gems, stamps, coins, precious metals. What if I lose money on investment? If you have capital losses from investment, you will certainly want to claim them on your taxes because you will be able to use them to offset any other capital gain that you have. Both long-term capital gains taxes and short-term capital gains taxes count towards your net investment income. The IRS looks at the total of the gains when calculating tax, which means your losses can offset some of the gains and soften the hit a bit. So you and your financial planner can strategically balance out your winners with some losers to minimize your taxes. If you have more losses than gains, you can even claim a net loss up to $3,000 as an individual or married filing jointly and reduce your overall tax burden. And many taxpayers make sure that they are taking any loss they are entitled to in order to minimize their tax burden. It's a practice called tax loss harvesting, and it can save you money. Came from April 15. Now we can conclude what we already talked about. First of all, we talked about dividends. Exist two types of dividends, qualified and non-qualified, and we talked about the difference between these two types of dividends. Second, about capital gains. Capital gains tax is only paid on realized gains after assets is sold. Capital gains treatment only applies to a capital asset such as stock, bond, jewelry, coins, collection, and real estate property. The IRS taxes all capital gains, but has different tax approaches to long-term gains and short-term gains. Taxpayers can use strategies to offset capital gains with the capital losses in order to lower their capital gains taxes. Here are the sources which I used for this presentation, and thank you.